Welcome back, everyone. We have some breaking news this morning. There is a report out of Business Insider where they spoke to Roku employees, and those employees are saying that talks between Roku and Netflix are heating up about a potential acquisition, that Netflix might be purchasing Roku. This is somewhat shocking news. This really wasn't on the table until just this morning. Now, just this rumor, even though nothing is solidified yet, just the rumor of this sent Roku stock up 9.8%, almost 10% on the day. Netflix is also up 2% on the day. So this is pretty shocking news, and I want to go over what this means for both Netflix and Roku, for the companies and the shareholders. We'll be reviewing the fundamentals of Roku. This isn't something that I've done before, so I'll give you my opinion on Roku as a stock, as a company, and the future of the company. And we'll also be reviewing the fundamentals of Netflix. Netflix is one of the companies in my story fund, and it's by far my worst performing stock. So I am in the red by a huge amount on Netflix. And even though I'm in the red by a lot, I still remain bullish on Netflix. I know that's difficult to believe. So I want to give my perspective on what this acquisition can mean. And we'll also, for good measure, just get some third-party perspectives as well. We have Rich Greenfield giving his opinion on this deal as well. So we'll be looking at that. So we have a lot of news to get to, a lot to unpack. Let's go ahead and jump right in. I'll start off with a portfolio update. For those of you new to the channel, this is called the Story Fund. It's one of my portfolios. It's a growth portfolio. And the idea behind this was to give my take on a growth portfolio. So I'm investing in companies that I think are undervalued and have long-term growth potential and generating far more free cash flow in the future. So I think these companies will be dominant. I think they'll continue to grow. And most importantly, I think they'll generate a significant amount of free cash flow. Now, I'm tracking the progress of this portfolio every single week. You can follow along for free by subscribing to the channel. I'll continue to show it come good or bad. Right now, it's just been disappointing. These companies across the board have been underperforming the rest of the market. And the things that are in favor right now are things I'm not investing in, like oil and consumer staples. So this portfolio has underperformed. The money-weighted return shows minus 39%, but the actual returns, the amount of money I've lost, is more aligned with 23%. I'm down $30,000 on a $130,000 cost basis, which is around 23.69%. Now, what I do is I track the performance of this portfolio and I benchmark it against the S&P 500 every week, and this is what it looks like. This is the latest update. You can see that we're quite a ways below the S&P 500, but we're actually making up some ground. We've actually closed the gap slightly by around 5% over the past month. And I think that this is just going to be a game of patience. It might take time for these companies to catch back up and get a bid from investors. But things can turn around quickly. If the Fed comes out and says that they're not raising interest rates anymore or as much as investors expect, we can see these growth companies probably do really well. So I'm going to be patient holding these companies. Even if these companies are in the red, I'll continue to hold them as long as the fundamentals remain strong. Because stocks in general trade on two basic things. They trade on the fundamentals of the company and the mood of the investor. And right now, the mood of the investor for these companies is very pessimistic. It's been a very long time since investors have been so bearish and pessimistic on tech companies. And I don't think that that will remain the same forever. I think there will be a time when investors' moods switch to the positive and they want to buy these companies again. So over the past week, we've closed the gap a little bit between the Story Fund and the S&P 500 just by continuing to hold these companies, really doing nothing. One of the biggest things that made gains, if we look at the past month, we have Alibaba up 29%, $1,600. So people saying that all is lost with Alibaba, over a 30-day period, it's up 29%. Salesforce is up 10.9% off the backs of really strong earnings. Amazon is up 6% for the month, and even Netflix is up 12% for the month. So even though these companies have been struggling and the past 6 months has been very tough, they can move in the other direction, I think, very quickly. Now, my worst performing holding by far is, in fact, Netflix. I'm down $17,000 on this holding, which is roughly 65%. So I'm in the red big time on this holding, and it was a mistake on my part. I overestimated the total addressable market of this company. My estimates were that they could grow to 600 million plus subscribers with relatively low resistance, and they had resistance at 220 million. So obviously, I overestimated their total addressable market by a huge extent, and a lot of investors did the same with Netflix. So the stock price of Netflix has taken a nosedive. It's down 70% from its all-time highs, but so has Roku's. Roku's another one of those pandemic winter stocks that was up 500% from the lows in 2020, and now it's down around 78% from its all-time highs. So all those gains have vanished away over the past year with Roku. And now we're getting reports that Netflix might be buying Roku. So let's go ahead and take a look at this report. The first thing that they outline here is that Netflix wants to have ads and Roku has them. So Netflix in their last quarterly report said that they would be introducing an additional ad-supported tier at a cheaper price just to serve a different price-sensitive customer. Some customers are more ad-tolerant and they rather pay less. So Netflix is coming out with that ad-supported tier, but the ad technology behind that is very difficult. And they say that in this report. Netflix is looking to introduce advertising to its service for the first time as it faces increased competition and subscriber loss. Roku has built a robust video advertising platform that generated $647 million in the first quarter revenue. So Netflix is wanting to get into ads. Roku is an ad platform. That seems like a match made in heaven, right? Then we have the additional news that Roku has come down in price, making it more affordable for Netflix. They say that Roku's valuation had plunged to $13 billion as of the close of trading on Tuesday. That's true, but Netflix's price has also come down recently, so both of the valuations are quite suppressed, but I do think that Roku is in a range right now where it is affordable by Netflix. I think that if Netflix wanted to buy the company, they're big enough that they could probably pull it off. One senior level Roku employee said the deal between the two companies would, quote, align well in terms of culture, business, and current valuation. Netflix is trying to get into advertising-based video on demand, and Roku has it. Now, I just have to point this out. This is the elephant in the room. They're asking senior level Roku employees what they think about the idea of their company getting purchased by Netflix, presumably at a big premium. Of course, they're going to be bullish on this idea. This helps their pocketbook. This helps them make money. Look at what just the rumor of Netflix acquiring Roku did. It sent the stock price up 10.5%. And this is a company that's been bleeding over the past year. It's down 70%. So if you're a Roku employee and you're invested in the company and you have stock options, you're looking for any lifeline. You're looking for any catalyst to get this stock price up in the future. And Netflix coming in and buying the company, of course, will be viewed positively. So while I'm sure that Roku employees are thrilled with the prospect of a potential acquisition from Netflix, I think that's more a personal view on what it's going to do to the stock price than actually what this deal means, because they're not highlighting a lot of potential issues and problems with this deal. Here's Rich Greenfield highlighting a few big issues with this potential acquisition.
Joe, I think this is one of the more absurd things I've ever heard in 27 years following media stocks. Honestly, think about what Roku is. Roku is a platform, TV operating system that is built into devices and dongles as well, little sticks that you plug into TVs. And everybody wants to run on top of that TV operating system, whether it's Disney Plus or whether it's Netflix. But getting into that, actually owning the business, Netflix owning hardware and basically prioritizing one hardware, meaning themselves, over the thousands of devices that Netflix runs on, seems completely antithetical to the everything that Reed Hastings and Ted Sarandos have built over the last 20 years. So
that's the first problem that he highlights, and I mostly agree with this concern. Netflix has worked to become a ubiquitous service that's just everywhere on every device, every part of society. That's what they want to be, a streaming service that everyone has for life. You have a lifetime subscription to Netflix. Now, if they start prioritizing Roku and they go into the device hardware category, it makes it harder to have that we want to be everywhere all the time on every single device ubiquitous nature. And so I do agree that this is a potential issue with the acquisition, but he goes on to highlight another issue.
It's very hard to understand, not to mention, Joe, as you know, Netflix's core business is not advertising, will never be advertising. Will a portion of the business now become advertising? 20%, maybe 25%. Anything is possible as they embark on adding an advertising tier. But remember, the core Netflix subscription is staying. They're going to add a lower price advertising tier to the subscription, the ad-free subscription tiers. And so it's always going to be a smaller portion of the business. And so to spend $20 billion, let's just say, to buy Roku, to make advertising this huge piece of the company would seem very, very out of character.
So the next concern he highlights is that Netflix is a subscription company primarily. Even though they're going to be adding an ad tier, that's not the nature of their business. And this would indeed be a huge pivot from where Netflix has gone from the beginning. Now, you might say that Netflix is just desperate enough that they're trying to do anything they can to grow the company, but I don't really think that should be the decision they make. I don't think because they're desperate to grow, they should be buying Roku that has its own sets of problems. And I'll highlight those problems in just a minute. Now, this next portion of the interview, I think Rich Greenfield really highlights the most important issue here, the reason that Roku employees would be chattering about this, and really the struggles and the tough road ahead that Roku's facing.
The reality is, think about what's happened to Roku. They're facing a lot more competition. I mean, your parent company, Comcast, just recently announced a joint venture with Charter where they're doing tvOS. Samsung is getting more aggressive. Google, if you walk into a Best Buy now, you see a much bigger presence of Google TV. The tvOS wars have really heated up over the last 12 months. That's putting pressure on Roku. We're also going into an advertising recession or, a recession economically, which is going to pressure advertising, but that's also hurt Roku stock. But the real pressure has been competition for tvOS is heating up. That's exactly, if I'm Netflix, I'm benefiting from these TV operating system wars. I don't want to move. You've already got the streaming wars that you and I and your team have talked about for years that Netflix has been competing in. You're going to add a tvOS war on top of the streaming wars? That just, honestly, it sounds crazy.
I agree 100% with him. Netflix already has their war to fight. They're already fighting the streaming wars. It's highly competitive. They're competing with all of big tech. And adding on Roku, which has an entirely different battle, a different growth path, a different war to fight, I think would make the whole story of Netflix even more convoluted, complex, and difficult for investors. I really think that this would be a really poor decision for Netflix. Now, I want to go into why this would be a poor deal for Netflix, why I don't think they should buy Roku. I'm going to highlight some of the issues that Roku's facing, because I think a lot of people are understating the path that Roku has ahead of them. They're facing stiff competition that I think is even worse than what Netflix is facing. Now, before we go into that, all right, now back to the video. I don't think that this acquisition from Netflix would be a good thing, not for Netflix investors or for the company. There's a lot of people on YouTube that they love Roku because it's one of the top holdings of Cathie Wood. And Cathie Wood has that aura of picking these high growth, disruptive companies. But I've said many times on record that I do not think that Roku is that disruptive of a company. I don't think it's innovative, barely at all. I think it's just a platform that has streaming apps on it and they run a little ad marketplace. I think that's all the company is. And I think the company is having a difficult time dealing with increased competition. We have this type of data we can look at. At first glance, this doesn't seem too bad for Roku, but if you really look into the numbers, it paints a pretty grim picture. If we look at this, we have the market share of the different streaming devices over time, from the top line here at 2015 to 2021. In 2015, Roku had a 35% market share, and then in 2021, they had a 36%. So you might be saying, well, that looks good. They gained 1% market share over this time period, so their market share is actually growing over time with increased competition. I don't think that's an accurate way to frame it. Their market share grew steadily from 2015 to 2019, but then the competitors really started to come out with their products. We have all these different competitors pushing into this industry at the very same time in 2020. And look what happened to Roku's market share. In 2019, they held 39%. Now they held 36%. Their market share is going down. It's not increasing. And if you look at the other companies here, look at Fire TV. This is Amazon's version of it. Theirs went from 12% in 2015 to 36%. They've literally caught up and matched Roku, and just from 2019 to 2021, they gained 6% market share. And I think between these two companies, Roku and Amazon is the clear winner. Amazon's gaining market share at a faster pace. They have their big store where they can subsidize their Fire Sticks indefinitely. They can always sell them at a loss forever. And that's something that Amazon will do with their deep pockets for a very long period of time. To the frustration of Amazon investors, they will continue to run at a loss until they defeat their opponent. And right now, Amazon views Roku as an opponent. That does not bode well for Roku. Roku's biggest competitor is Amazon, the most ruthless company in the world. Let me just remind you of what Amazon's willing to do to their balance sheet, what they're willing to do to investors in the name of competition, in the name of destroying other companies. Here's their expenses since the beginning of the company. If we just filter this by research and development with things that they're working on, last year they spent $56 billion on R&D. That's more than Microsoft, more than Apple, more than Facebook, more than any company on earth. $56 billion on R&D. Now, if we go ahead and look at their CapEx, what they're willing to spend to compete with Walmart, Last year, they spent $61 billion on CapEx to grow their infrastructure to twice the size. Amazon is willing to spend a bottomless amount of money and throw their free cash flow in the negative by $14 billion in the name of competition, just to gain an edge over their competitors. And this is just one of the competitors that Roku has to compete with on a hardware basis. Then if we move on to their next biggest competitor outside of Amazon with the Fire TV, we have Apple TV, which Apple TV's lost 1% over the past 3 years, but they still lost less percent than Roku. So Apple TV's actually stealing market share from Roku along with Amazon. Both of these companies are taking market share from Roku. And Apple, of course, is also not a competitor to underestimate. In fact, there's a report that Apple has been working on a cheaper version of their Apple TV. The reason that these Apple TVs aren't in more households is simply the price point. They're like $150+. So most people will go with the cheaper Fire TV and the Roku rather than picking the premium Apple device. But Apple has been working on a cheaper version of this product. And I think if Apple gets that price point below $100, they get these things into Costco's, I think they'll sell like hotcakes. I really think the high-end clientele will start buying Apple TVs over Roku's. Because in my experience owning both of them, I think the Apple TV is far superior. There's also a lot of reports that Roku is struggling to grow internationally. They're not having the same type of adoption that they did in the US, and the competition is heating up like crazy. Now, on a fundamental basis, Roku has also faced a lot of challenges. The revenue growth looks strong on a year-over-year basis, right? From 2020 to 2021, they grew revenue by about $1 billion, which is really fast. So I will give them credit. They're growing their company's revenue quickly. If we flip this over to quarterly though, we can see that from the last quarter, they're not growing at quite the same pace they were a year ago, which is to be expected. They can't continue to grow that fast forever. But last quarterly revenue growth was 28%. So a rapid decline in revenue growth. Then if we go back to yearly here, we can see that the free cash flow in 2021 was only $188 million. With $1 billion in gained revenue, their free cash flow was $188 million. So they're not a really high free cash flow company. They are doing share dilution year over year, and the expenses across the board for the company, the CapEx, the sales and marketing, general and administrative, the research and development, these are rising at a really rapid pace as well. In aggregate, they make up around 50% of the company's revenue. Now, Netflix does have their problems as well. Fundamentally speaking, they are growing their revenue, they're growing their EBITDA. Their free cash flow last quarter was a positive $801 million. So they actually beat their free cash flow estimate. Part of my investment thesis on Netflix is even if they continue to grow at a slower, more incremental pace, they'll continue to grow their free cash flow. And Netflix's expenses outside of their content budget is around $6 to $7 billion per year. So last year they made $29 billion and their overhead $7 billion. So overall, as a Netflix shareholder, I don't like this potential deal. I hope it doesn't go through for a number of reasons. For one, Roku's not a really strong company. And I apologize if you're a Roku investor, but I say that based off the fundamentals. They're not generating a high amount of free cash flow. They're not really profitable. They're facing steep competition with big tech. And that's similar to the problem that Netflix already has. Netflix already has big tech as a competitor. Now imagine if they buy Roku and they're competing with big tech on two fronts, both in hardware and in the streaming services. And I think that if Netflix did own Roku, it'd make it more hostile of a relationship for Netflix to get other streamers on the Roku platform. Because other streamers like Disney Plus and Peacock and Amazon Prime would say, we don't really want to be on Roku as much now that Netflix owns it. One of our competitors owns the platform. So I think there's multiple problems with this. I don't think it would really benefit the Netflix shareholder. There could be some synergies. There's the ad technology, so they'd have that portion of it. But I believe that Netflix could figure out advertising without owning Roku. Overall, I don't really love this idea. I'm interested to know your thoughts though. I'm open to suggestions. I might change my mind, but right now I don't see how this would work out well for the Netflix shareholders. So that's my thoughts on it. Let me know what you think, and I'll see you in the next one.